Hey everyone, so jumping back into this, we've looked at two critical things: how to look at rates, how to find rates, and we'll jump into that as a quick recap. But then also, once you found a rate, how do you leverage it? How do you access it? How do you put money into this protocol, this pool, and earn from this rate? Now that we've covered that, there's a key question that we haven't really answered, and this is kind of to pull it all together, but is the rate here to stay? Just because you see a certain rate of 8%, 10%, 13% returns, in terms of APY, right, annual percentage yield, it doesn't necessarily mean it's going to be there for the whole year. It's not locked in. It's not like a savings bond. So how do you know the rate is here to stay? One thing that we looked at was in our past video is how to find these rates using DeFi Llama. I'll include this in the link and we'll do a quick recap. You might want to go check that out before we jump in. But before we jump in as well, I want to do a quick recap of not only are these rates here to stay, but and how we find them, but why are we doing this, right? So we think this is a $100 billion lending market. We know this is a $100 billion lending market, and we think this could be the next big opportunity for normal people to tap into. This is Bitcoin before it was normal on Coinbase. This is trading stocks before it was normal on Robinhood. We think this is something that's been happening now with very advanced traders and people within finance, but it's not happening for normal people. And we think we could change that. The signs of it happening is there's $40 billion just in these lending pools and protocols alone. That's a huge amount of money. Between all that money being traded, there's 83 million active users, which is a good, healthy ecosystem across the world, but this could be much bigger. Most people, even within the US, don't even touch this. And we think that number could be more like a billion. And then the returns are just consistent every year. So 20 to 30% returns year over year. That really beats the S&P, even on good years, and that really beats your traditional savings rate. So this is why we want to kind of learn this nitty gritty stuff, try and make it more mainstream so more people can access it. There's two things to understand if the rate's going to stay that we'll look at today. One is prediction tools. So how can we use exponential phi to look at what's going to happen? And the two is just better understanding the pool breakdown. What is in it? How is it constructed? How does it pay out? So let's do a quick refresher and jump into the DeFi Llama page, which gives you the overall view of what's going on. View this as like a scoreboard where you can check all the rates. And then we're looking at the APY here. There are some pretty good basic numbers, right? 5.5%, that's solid. And there's some eye-popping numbers here. So 40%, 49%, 48%. Let's look into some of these. I can tell you right now that if it's 50%, it's not here to stay. That is just too damn high. They are not doing anything shady necessarily, but they're basically spending money in terms of marketing, or they are filling a very much needed gap, but that gap will be filled within a few days and that will not last forever. So not saying don't do this, but don't expect this to stick around. So let's just remove those. Let's look into something a bit higher, but not necessarily unreasonable. So let's look at this WETH to USDC pair here on Aerodrome and pull that up. So a few things to look at when viewing this pool and this pair here. This is a pair between a derivative, so wrapped ETH, and then USDC. USDC, we fully trust, we very much know. Wrapped ETH is a derivative, right? Regardless of how it's structured, what ETH is, what wrapped ETH is, just know that it is a derivative. So it's a wrapper of a thing. And whenever you wrap something, there's always extra risk. So immediately before even looking at the risk here or any more details, just know that this is higher risk. It does state that when it comes to the total risk rating. So it gets a B, which is actually very good. And then the only flag here is that it has an average pool design. So what does that mean? Basically, I would take a B as good. Pool design means that it's not very diverse necessarily, and there could be a lot of different factors going in here, or it's just really, based on this pair here. Again, we're not going to go super deep into wrapped ETH, but it is a derivative, and therefore it's hard to know exactly what's in the pool design. As exponential phi has labeled this low risk, but what they've really done is this outlook thing. And we haven't touched on the outlook, but this is a great tool, kind of like the kayak of rate predictors. It is predicting where this is going to be. And it actually says that it's going to fall below 10.96% within the next 4 weeks. That's pretty great in terms of understanding, hey, this is actually going to drop significantly. Not great for the rate, but still very good in terms of going from 13 to 10. It is still a very high rate. So that's one indicator of, hey, this probably is going to drop. And then the other indicator I'd look at, right, beyond prediction tools and exponential phi, is the supply APY. How variable is it? How much does it go up and down? Have there been spikes or valleys? It looks like it's pretty consistent here in terms of it's really not going below 10%, which is great to see. And that means I think you could see a 20 to 30% drop, but I think that's worth stomaching because that still means it'll stay above 10%. I would also look at these spikes in terms of it could go much higher. This is more of like a bull run time period, so I wouldn't factor that in or expect that. But I think this rate is here to stay above 10%. I don't think it's going to stay in the 13%. One thing to note, however, is yes, this rate is here to stay, but it's highly dependent on one major thing. And if you don't know how to do this or you're not comfortable or familiar with it, this is a good sign to stay away from this for now. This is not paying out in any base token. So it's not paying out in USDC. So what you're putting in is USDC. What you're getting out is something else entirely. What it's paying out is this Aerodrome token, which is great if you believe in Aerodrome. But if you are unfamiliar or you just want USDC back, so you want to put in A and you want to get back out A, this is not for you. The rate might be predictable, but if you're expecting USDC back, you might not get that. So if you're bullish on Aerodrome, I would definitely check this out. It's a high rate, but again, risk reward seems to be there with a low risk rating and a consistent rate over time. But I would always check it out and drill a bit deeper into the exponential phi dashboard. This is a great tool. Again, it's kind of like the kayak in terms of predicting, but it's also kind of like the nerd wallet of DeFi, of giving honest and straightforward breakdowns. But you can see that already $200,000 of rewards have been paid out in the past 30 days. That's a good amount of money. 14% yield over the past 30 days is solid. And then a very healthy TVL, so total volume of 20 million. We tend to look at this in terms of anything above 10 million is usually pretty good. Anything below that, you're kind of getting risky. So overall, looks pretty solid. Definitely dig more into the pool design in terms of the underlying assets, but with a B rating and slowly getting into this and not just going all in, I think it's a pretty good approach and the rate is probably here to stay. So if you have any questions, reach out to us. If you want to hang around and see how Nook works, we're going to show you how it works in the app. It's going to be a different video, but it basically shows how you can tap into a rate like this on base with USDC just using an iPhone and with a couple minutes of your time. Cool. So thanks for listening. We'll pause there and go from here. Okay, cool. Now we're going to go into the Nook app to see how we can do it from the Nook app on an iPhone. If we open up the Nook app, you have two options. You can sign in or sign up. Let's hit continue to sign up. We break down the current savings rate, how you can earn in core and extra rewards, how it's safe by being collateralized, and how your Nook wallet's always yours. So the same premise of what we walked through on web with the Moonwell site, but a little bit more distilled down. Bear with me as I create a test account. That's a one-time code. I agree to the terms and agreements, right? So you're using Moonwell, but your funds are always yours. Let's go ahead and allow notifications here. And now we can see just the interface of deposit screen. Clear breakdown of past 365-day rate, the current rate, and your balance down here. If we tap learn more, we can see more here. But let's go straight into our first deposit. So similar scenario, we want to put $5 on, press continue, pay with Coinbase, let's continue. And we go through a similar flow of on-ramping. My wallet has already been created for me in the background, so I didn't need to go to coinbase.com. I'm logged in, so I can press confirm and purchase. It is buying crypto, taking that USDC, and sending it to my Nook wallet. $5 sent automatically redirects me back to Nook. And we sit tight as the USDC arrives and then goes into Moonwell. So there's no step of opening Moonwell and depositing Moonwell. It goes straight into Moonwell. Just takes a moment. And voila, we are done. $5 deposited straight into Moonwell, earning 4.8%. You can see I've already started earning down here, the details page, and then go to your account page or settings page to log out or export your wallet. And that's how we're able to get set up with Nook in probably 2 minutes versus 5 minutes in a much simpler, easier way. Thanks for watching. I hope you stay tuned. Talk soon.